Good morning again. Good morning again. I'm making quite a few videos here these last few days, trying to get caught up. I'm going to try to get through this video series on options as quickly as I can. So anyway, again, Ken Creager from Black Swan Financial Advisors. I even have my little logos up behind me there. Proud founder, sponsor of the community at Possibilities Achieved. Please spread the word and tell people about our collaborative community that supports families with family members with special needs, and point them to our Facebook site and sign up. And families, caregivers, service providers, people that help with employment, people that just want to help join the community. So let's just jump right into it. So this is video number 3, even though it's the 4th video. Again, remember, all these videos are for educational purposes only, and I'm also putting together an advanced options course. This is just introductory. Not really going to show you specific examples, trading examples, and so forth. The advanced course, which will cost a little bit of money. It's pretty cheap. It'll be cheap. But I'm going to go into a lot of detail, and we'll do some live trading, and you can actually see how it happens, which is super important, because I remember when I first got involved doing options. Remember, options are leverage, and also there's a lot of new information, strike prices and dates and puts and calls and everything, and it can be a little complicated when you start out, and you can make mistakes when you do trades. So if nothing else, if you do this on your own, or you can even just contact me, and we can maybe work something out. Start small, be careful, and go from there. So we're going to talk about a strategy called covered calls and protected puts. Pretty conservative strategy, and we'll just jump right into it. So what is a covered call? We talked about calls before are the right to buy, not the obligation, but the right to buy the underlying stock at a certain price, the strike price. So what is a covered call? Actually, what a covered call is that you already own the stock, and you're going to sell somebody else a call, which is the right to buy your stock. So you need to have 100 shares, at least 100 shares. 100 shares equals one contract. Remember, one options contract. So for every 100 shares, you could sell one covered call options contract per 100 shares. Very important to remember. And it's an option, you like that, play on words. It's an opportunity where you're sitting on a stock that you own. Maybe it's been going up, maybe it hasn't, but you don't want to sell it, and you want to get a little money for it. You want to, other than the appreciation. So you can use this strategy to generate income from premiums that you receive, but you have to realize that it limits the upside potential of the stock. Because what you're going to do is you're going to identify the upper end of the stock price at which your 100 shares is going to get called away, and the person that you sold the call option to is going to get your shares. Okay, but they're going to pay you money for it. Okay, and it's typically used when an investor is neutral or slightly bullish. They don't think that the stock price is going to go up 50% or 20%. Slow growth, but it's a way to generate some additional income. Maybe you need some income to live on, or to reduce the cost basis of your stock. So you can do this and just keep chipping away at that initial cost of your stock, okay? So let's jump right into it. So a protected put, that's the other one that we were talking about. Again, this is on stocks that you own. The calls, remember, this is selling. You sell. And remember, almost 85% of all options expire worthless and sellers win. That's why this strategy works pretty good. This is really about insurance, okay? When you buy a put, it's to give you insurance, downside protection, limiting potential losses. And you have a stock that you're holding and you don't want to sell it. You believe in the long-term outcome of your stock going up, but maybe you want to hedge or protect yourself against some downside risk. So this is a hedging strategy. I briefly mentioned it in a video too, where I would buy some protected puts for insurance on my overall portfolio. Okay, so let's just jump into this. This is an example. This is a super busy slide. Bear with me. In this example, hypothetical, you own an ETF. They're called Spider, SPY, SPY, and you have 200 shares, okay? And you're going to sell a call on your 200 shares to get some income. And you want some income or you want to reduce the cost basis, but basically you want to get some money. So here's how it all works. So I'm going to sell a call, okay? This is the current price. $395.60 for SPY. And if you look, you want to go out 30 days, 60 days. So this is like almost 2 months out. And I want to pick a price a little bit above the current price, because if somebody ends up owning my stock and my stock gets called away, not only do I want to make the premium from the option, but maybe I want to make a few bucks in appreciation, right? So that's what I'm doing, is I'm picking a strike price that's $1.40 above the current price. And look at the premium on that call. Somebody's going to give me $12.23 per share to buy this call on 100 shares. So if you take 12.23 by 100, that's 1,200. Somebody's going to give you $1,223 per contract. And remember, they're called covered calls because you own the stock. If you sold more than 2 options contracts, say you sold 3, 2 of them would be covered calls and the other one would be naked. Usually, as it implies, usually naked is not a good thing, okay? Got to understand the risk there. How much income am I going to get? So with 2 contracts, somebody's going to pay me $2,446, right? So what's going to happen? Again, remember that expiration date, okay? So on or before May 19th, on May 19th when the market closes, this will expire worthless. And since you're a seller, you probably want it to expire worthless, because if it expires worthless, you get to keep the $24.46 and your shares, okay? Now what happens if the strike price is above, if the current on May 19th, Spider is worth more than 397. Say it's worth 400 bucks, okay? Right here where it's worth 400 bucks. So it's going to get called away. Your 200 shares are going to get owned by the person that bought your calls from you. So what's going to happen is you're going to keep your $24.46, plus you have an appreciation of $1.40, difference between $395.60 and $397. And so you're going to end up earning $13.63 per share, or about almost 3.5% for less than 2 months. But you have to realize you'll no longer own these shares. And when I do this and I still want to own this stock, I'll just turn around and sell some puts and buy the stock at a discount and get it back. But this is a way, basically, you've earned 24.46 plus the 140, right? You've earned pretty good return on doing this. And if the stock price on May 19th is below 397, then you keep your shares and you keep that 2,400 bucks. So that would lower your cost basis basically by $12.23 a share. And you can do it again. Okay? All right, protected put. We're going to do the portfolio example because this is kind of what I do myself. Again, educational purposes only. But let's say you have $100,000 invested in various stocks or ETFs or whatever, and you just want to get, maybe the Fed's going to make an announcement or whatever, you're worried about earnings, and you need some short-term protection, okay? Or you could go longer term. It will just cost more. Remember, when you buy a protected put, it's insurance, okay? You're getting an insurance. You want short-term protection. So we're going to try to get some protection for this $100,000 portfolio, okay? So let's talk about this. We're going to use Spider again. Again, we're only going 2 months out. You could pick a strike price a lot lower than 394. Maybe you pick 380 because you're only worried about, a significant drop. And the price on a 380, would be way cheaper than, this is only $1.60 lower than the current strike price. And so the premiums are pretty high. So I'm going to get insurance for about 2 months. What is it going to cost me? How much insurance do I get? Remember, options are leverage. So price movement means bigger movement in the options themselves, okay? So in this example, I'm going to buy the put. I'm going to buy the put, buy to open, with a strike price of $394, and it's going to cost me $9.33 per share, or $933 per contract. But kind of how much equity does that insurance cover? Well, if you think 100 shares by $395.60, 39, almost $40,000. So if I was trying to insure my whole portfolio, I'd probably buy 2 contracts, right? Maybe I just want insurance on part of my portfolio. Maybe this is enough. You decide. This is for educational purposes only. But again, what happens on May 19th, at or near May 19th? So you've bought this put. So on May 19th, you remember, you're buying insurance. So the insurance is only going to pay you off if the market melts down, right? Your house is on fire and the SPY goes down a lot, right? That's when it's going to really pay you off, right? There's a big loss. That's what insurance is for. Your house is on fire. Spider is on fire. Okay, so let's say Spider on May 19th is 345 bucks. Okay. Now remember, don't let it expire. If you own it, if you bought it, you don't want it to expire. Okay, you need to either sell it and make a profit or exercise it. Since you own these, say you own some Spiders, right? If you own them, you could sell them for $394, no matter what the price is. If it could be $300 and you'd make $94 a share. But let's just say you're just going to sell the option, because the option's going to be worth it, because somebody else out there has some SPY shares and they're going to want to be able to sell it at that higher price. So the option itself is going to be worth at least $50 a share, because that's the intrinsic value, the difference between 345 and the 365. Well, actually, it's the 394 between the strike. Okay, it's almost $50. But then there's time value as well, right? So remember, so it's going to kind of depend. You might want to sell this one and take the profit. You know, if your insurance, it's kind of like buying insurance on a house. And right before your house burns down, you don't renew your insurance, okay? So your insurance needs to be in effect when you execute and do the transition, right? So if the market's been going down like crazy, and that's why you bought this protected put to begin with, then maybe a couple days before May 19th, you could sell this option for a big profit, and that would offset the losses from your portfolio, right? So maybe, say the general market is down 10%, you know, well, actually, this is, say the market was around 400 and it went down to, you know, 345. That's almost 20%. That's what? That's 15%. Well, your option, though, is going to be up hundreds and hundreds of percent, right? So it'll be worth at least $50 a share, which is $5,000, right? So you paid almost $1,000 for it. So your contract is going to be worth 5 times or higher than what you paid for it. That'll help offset your losses. That's why you do one of those, offset your losses. So anyway, remember, most options expire worthless. So that selling those calls on something you already own is a really good way to get some income or reduce your cost basis. Make a little bit of money while it's just sitting there. Okay? So sell that call if you want some income, and buy that put if you want some insurance. This video has been for educational purposes only. Please remember that. Hope it's helpful. Look for my my course that'll be coming up. Join the community at Possibilities Achieved and encourage others to do the same. Thank you again, and stay tuned.